Don't get technical with me.
But enough of my technical mumbo-jumbo. Allow me to demonstrate.
Welcome to Talking Technicals, where we do try to demonstrate that it's not mumbo-jumbo, that it is a lot of science that goes along with the art of looking at the charts. And today we are talking to John Kosar. He is the Chief Market Strategist at Asbury Research. If you want to learn more about the firm, it's asburyresearch.com. But I know that John has a lot of fans among Money Life listeners. And if you're a fan and you want to get more information, John's got a new Substack. So it's asburyresearch.substack.com. We've got that plus a link to Asbury's YouTube channel, where you find John on our recent and upcoming guest page at moneylifeshow.com. John Kosar, welcome back to Money Life.
Good to be here, Chuck.
We are talking at a spot where the markets have been around record highs, seem to be maybe struggling to make more progress here with the election so close in the offing. For you, do we have to kind of wait to see any direction until the election is done? Or are we going to have like a move now and then a quick move regardless of who wins?
Well, I've been doing this long enough to know that nobody knows. Logically, probably managers, well, I think managers don't want to get too far over their skis. They don't want to make too many aggressive bets between now and the election, because the election, by most polls that I've been watching, is kind of a toss-up. Nobody really knows how this is going to resolve itself. So even though we've been making fresh highs in the major indexes, well, specifically the S&P 500, the sector rotation, which is what's going on. So there's 11 sectors of the S&P 500, and if you add them together, it's the S&P 500. The rotation between those sectors has been really frenetic. Technology one week, utilities the next week, all over the place. And I think that's telling you, even though at first blush you might say, well, everything's hunky-dory, the S&P 500 is making all new highs, there's a lot of churning going on underneath the surface of the market that if you're not looking carefully, you're not going to see it. It means the market doesn't really know exactly what to do here. It knows that the economy is very strong. We've the strongest of all the biggest countries coming out of COVID. Unemployment rate is 4.1%. Inflation's coming down. The economy is clicking, but the managers are not making aggressive bets on any sector because depending on who gets elected, the favorability of those sectors is likely to change.
But you are risk on at this point, aren't you?
Yeah, we've been risk on since early part of August. The correction protection model, or CPM model, which basically over the past 7 years, it's stuck like glue to the S&P 500, but with about 40% less risk. A lot of our customers are older, they're wealthier, they're more risk averse. They want to know how they can play the game with less risk. They're not maybe interested in taking big bets or putting on elaborate strategies to try to make 50% in 1 year, but rather be in the market, be able to capture what the market gives you. I think the market's been on average over the past 10 years, it's been about 11 or 12%. If you annualize that, they're happy to get somewhere close to that without a big drawdown. And that's what our CPM model does. And that's been risk on since the early to middle part of August.
In terms of what you see happening now, I mean, when you are risk on, obviously you see positive things ahead, but is there a level that you believe that resistance will set in, that we're going to need to have some sort of a setback?
There's a big level that I'm paying attention to right now. It's the old highs. I don't have the number in front of me, but it's the July peak that we made in the Nasdaq Composite Index. We've been testing it for almost 3 weeks. We've been bumping up against that level. If we can get through that level, by getting through it, I mean, I want to see a couple of 2-3 closes up above that level. And you can go to any chart free on the internet and be able to see that level. We're tickling it today. If we can get through there, that's going to clear the way for more upside from technology. Technology is typically necessary to perpetuate a bull market. And we're bumping up against that now. Now, the good news is NVIDIA, which is a very tight linear correlation for 20 years with comp, the bigger index, that broke out of a very, that made fresh highs here last week. So as NVIDIA goes, NVIDIA is the second largest stock after Apple, according to market cap. So NVIDIA breaking out last week implies that the bigger index should follow because of the close linear positive correlation between the two data sets. So we haven't broken out yet, but NVIDIA suggests that that's how the market's leaning right now.
Do you worry when you have your indexes so tied up in a couple of stocks? I mean, NVIDIA, where it's grown to, is such a monster. I mean, it is the 800-pound gorilla. Do you worry that just as we had the Magnificent Seven driving things up for a while, that we have some sort of a disconnect? Right now in this country, the economic numbers tell us we're doing well, yet everybody says, I don't feel like I'm doing so well. Is that the same with the stock market, where the index is telling us we're doing well and the couple of big names that really drive the index are doing good, but the rest of the index unimpressive to you? I mean, small caps and the rest, is there any there?
Well, we follow I've been doing this for 43 years, did a lot of forecasting. My first 20 and my last 10, I don't do very much forecasting anymore. I follow data. It took me 20 years to figure out that me nor anybody else on the planet knows what's going to happen in a week or 3 weeks or a month or a quarter. So I'm reading the data every day. We're watching inflows, outflows in some key ETFs. We're looking at volatility. We're looking at relative performance. We're looking at the spread between stocks and bonds, all these kind of secondary indicators that tell us what the underlying health of the market is. So NVIDIA broke out hard on this first or second week of January. If you would have said, well, that's NVIDIA, or, how can one stock possibly give me a good year? Well, you would have missed the 20 or 21% the market's up since then, since the beginning of the year. And since October of last year, almost exactly a month, it'll be a month in just a few days, or actually today, since the 27th of October of last year, the S&P is up 42%. Enormous move. So if you're trying to overthink this and saying, well, what if this dies? Or what if this, I've never seen this before? Or how can these 5 stocks, you missed out on a big opportunity. So I kind of have my ear to the tracks. I'm waiting for these secondary indicators to tell me the market's getting jumpy. It's getting some anxiety. It hasn't done that for most of the year, and we've been long for most of the year. We've had a hell of a year by not trying to overthink this and think of what the sustainability might be. We're just following the data day to day and week to week.
What would make you go risk off at this point?
A combination of things. I would, first of all, volatility has to rise and stay elevated. We look at the VIX for that. The VIX has been low and steady for weeks, if not months. The last time that we had a jumpy VIX, I believe, was back in July, August, if my memory serves. I need to see assets contracting in key ETFs like QQQ, which tracks the Nasdaq 100. That's the Nasdaq. That's a smaller of the Nasdaqs in terms of constituency, but much bigger stocks. NVIDIA's in there. Apple's in there, obviously. SPY, which is ETF that tracks the S&P 500. I need to see asset contraction. In other words, people not willing to hold those ETFs overnight anymore. That would be one. Volatility would be one. Seeing stocks starting to underperform bonds, that would be one. There's a short list of these that we've formed into one of our models called the Asbury 6. That's updated every day. That tells me if the market is internally healthy enough for us to be risk on. When that changes, that will tell me to start playing defense. And what that defense means different things to different people. For me, I may get out of some of my equity exposure. I may be putting on more defensive strategies, but until that happens, the party's on and I'm attending.
We talked about how you can't really tell much in terms of what will happen with the market from an election standpoint. And I know that whoever gets elected, that's not a technical issue. But do you have a sense in terms of what your expectations would be about whether or not one candidate or the other will be particularly good or difficult for the market?
Well, I do, but I've made it a cardinal rule. I keep politics out of what I am doing for two reasons. One, clients don't want to hear it. They don't care. Everybody's got their own opinions, and I do too. But secondarily, I think it takes my eye off the ball. And the ball is the market will tell you by these indicators, some of which that I've mentioned, like volatility and asset flows and relative performance. The market will tell you what it's thinking. It'll tell you every day what it's thinking. That's the only person in the room, so to speak, that matters, is the market. And so, I stick to the data. If the data tells me if candidate X gets elected, now I'm looking at that data. What does the market think of that candidate? Because what John thinks is meaningless. As long as those internal indicators indicate the market's healthy, I'm on board for that. We're going to be exposed to equities as we've been for almost all this year. No matter who gets elected, if the market doesn't like it, I'm going to see it in my data and I'm going to change my tack. And it's as simple as that.
And as non-answers go, John, because I'm never big on doing the political thing myself, I'll take that as a non-answer because there's an answer in there, which is don't worry about who wins, worry about what the market tells you once it knows who has won. John,
the market is the only voice that matters. Absolutely.
John, great stuff. I appreciate it. We'll talk again soon. Thanks for joining me on Money Life.
It's great to see you, Chuck. Thank you.
That's John Kosar. He's chief market strategist at Asbury Research. AsburyResearch.com is their website. AsburyResearch.substack.com is their new Substack. And then again, they've got a YouTube channel. If you want to check that out, we have a link on the Money Life Show guest page where you find John. Up next, we're heading back to my interviews from FinCon. My friend Marty Steffens, the SABEW Endowed Chair for Business Journalism, will be here next talking creators versus journalists. And then we'll be talking with Paula Pant from Afford Anything, plus her parents. This is Money.